Good afternoon, guys. It's Saturday, June 4th. My name is Dave Coker, and this is Talking About Finance, where we talk about finance. And just got a bunch of signups to the channel recently. Thanks for subscribing. Little background, just in case you didn't know. Me and my friends, there's about 40, 45 of us. We got a Telegram channel, collection of current investment bankers, retired investment bankers, and other people working in finance. And what we do is we just bounce stuff around, talk about finance, try to come up with ideas, blah, 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 all the time. And I bring it to you. So we're going to start out, as we always do, by looking at performance of the S&P 500. And we're going to look at 1 week, because year-to-date is just too depressing at this point in time. So let's see. The S&P 500 is up about 1.25% on the week. You can see some green, very, very welcome. It's still down about 13.8 year-to-date, 13.8% year-to-date. It's fine. Keep the faith. The VIX traded down this week, closing at 24.79. Not bad. The 10-year note closed at 2.74. It's up 1.2% year-to-date. So yields are fine. That's interesting. And oil closed the week at 120.27. It's up about 4.5%. Week on week and about 59.9% year to date. Once again, keep in mind, Goldman said anything north of 30, U.S. is drifting into recession. So we'll have to see. But regardless, it seems we still have strong job growth in the U.S. economy. We'll talk more about that later. But that's keeping the economy, the consumer spending, which is keeping the consumer afloat. And we'll talk more about that later. Keep in mind that in America, some 70% of GDP is driven by consumer spending. So regardless of the cause, it's encouraging that we're still seeing healthy spending. Unemployment isn't yet signaling a recession, but we do know that unemployment tends to spike up right before a recession. In other words, it's a leading indicator. Wage increases are likely to keep the Fed on track for 2 50 basis point hikes, one this month in June and one next month in July. But we've got great hopes. They're going to pause there. But we'll have to wait and see what happens. Until then, buy yourself some dividend-paying stocks, sit back and let the cash flow in. Just chill, dudes. Remember, Tina, there is no alternative. And unless you're talking about crypto, and you definitely need some crypto, Tina. So you definitely need stocks and you need crypto. And finally, as I mentioned, I bought stocks this week. I used May's cash flow, and I'll do the same thing in the first op in July. I've been doing this for decades, guys. I tell you, I do it all the time. I use other people's money to buy me dividend-paying stocks. Can life get any better than that? I don't think so. All right, let's dive in a little bit. Now, if you've been listening to the channel for a while, you know that I fervently believe, and I do speak in public a great deal, and I mention, we do not give the Chinese enough credit for showing us the way. Case in point, COVID. Think back just 2 years ago, 2.5 years ago, when China first started locking down, all you heard the Western media talking about, babbling about, was the authoritarian Chinese regime, blah, 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 not in the land of the free. And yet we locked down in England. We know they locked down in the States. They locked down on the continent. We should have done it sooner, but we didn't. We got our eyes closed with China. Here's an interesting thing about Chinese ISM and China PMI and US ISM. And it's interesting to look at the Purchasing Managers Index in China and the Institute of Supply Managers Manufacturing Index in the States. And this came off some research by Nomura. It postulates that there's about a 6-month lead to what happens in the States by what happens in China. Don't know. I know you can go on Fred, which I use a great deal, and duplicate this chart. Maybe I'll do that before the next time we get together, and I'll post my results. But still, we know the Fed is dead set upon raising interest rates, and the Fed wants to correct the red-hot labor market. They've talked about this many times. What we've got here is we've got the ratio of initial claims in the civilian labor force. So I've just normalized it by dividing by 1,000, then later on multiplying by 1,000. And you can see the Fed has been very vocal. They want to return to pre-pandemic averages. So take a look at this, guys. The pre-pandemic average is a little bit north of 2. It's like 2.1%. We're currently running at 1.1. April 2019, right before the pandemic, we topped out, or we bottomed out at 1.2. And you can see how it's run before in prior cycles. So they are focused on the number of jobs out there, and they've been very vocal. The Fed's been very clear in their communication. They want to tamp down on the red-hot labor market. They think if they do that, they can stop wage inflation, and they've got this idea that they can correct inflation overall. Well, you know, they're the Fed, now I'm just me. I don't know. I'm a little dubious. But still, we know the consumer is spending, as we mentioned, and that's actually sort of positive, but it's actually sort of negative, guys, because of this. We see consumer debt soaring. So yes, they're spending. Where are they getting the money? Really interesting here. We're looking at loans on credit cards and other revolving debt plans. And you can see we hit a low. It was really wild. We hit a real low in 2020. April 2021, where it went down to 741 billion. Before that, in 2020, March 2020, 859 billion. And now we're topping out and we're pushing past it at 872 billion. It's been a fairly sharp increase, some 17% from the lows in 2021 to 2022. Where's it going to end? I don't know. It's interesting because inflation is insidious. And really, you know, people don't really pay attention to the cause, at least our elected officials. They like to talk about energy costs and things like that. You know, I was talking this morning about it. It's interesting because with the Western democracies, meaning the US, the UK, and Europe, printed money heavily. Now they've got rampant inflation and they blame it upon supply side issues. And Mr. Putin, what about Switzerland? In Switzerland, inflation's running about 2.4%. Well, where are they getting their oil from? The same bowl that we all get it from. So they're subject to the same supply side issues, exposed to Mr. Putin as well. But no, inflation's not really out of control there. It's interesting. We'll have to see what happens with the price of oil. And it's interesting because this came up in a research note this morning. Oil's just not going lower. What we've got here is we've got commodity futures, the US WTI crude oil contract. And what we're doing is we're looking at spot price, and you can see spot price roughly 120, right along with market. But if you look forward, if you go out 2024, 2026, 2028, 2030, all the way out, that price continues to decline. So until these prices rise, this analyst suggested, suppliers of oil have no incentive to increase production because they'll be selling for lower and lower prices in the future. Why would they do that? They won't. So think about that. So unfortunately, until they really sharply raise energy production, it looks like we're going to drift into a recession at some point. In fact, some people say we're already in a recession. Now, I love anecdotal indicators, guys. And I got it from Peter Lynch's book, One Up on Wall Street. I've got my own collection. This is not mine. Don't get that idea about me. But yeah, this was an interesting article. It was in the New York Post, I believe, about strippers. Think they can predict recessions better than the bankers. Why? Well, the bankers are their clients, and when times are good, when money's flowing, the bankers head out and they entertain clients with strippers. It's not my thing, all right? I'm just saying how it works, right? And this young lady and a few of her colleagues actually suggested we're already in a recession in New York. Why? They ain't seeing bankers like they used to, right? So the bankers aren't spending and the strippers are a little upset about the lack of funds. Who can blame them? That's how they make their living. This is a really good one. I do remember this headline in Business Week 1999, and the battle was between eBay and Amazon. And we know who won. Amazon's got 45 times the market cap of eBay now. They stomped them into the dirt, even though eBay was there first. Really interesting question. We were talking about this. What's the current battle? Sometimes we can't see it until we're a few years out. I've got some ideas. We'll talk about them, and check my blog out. I do post them a fair amount. But yeah, there's definitely a current battle going on now. It's really up to you to spot it, to take your pick, and hopefully to make some money. Okay, now, we always end up with Bitcoin. And we're calling upon the young ladies this evening. Tim Draper wrote this. I didn't. I just thought it was an interesting headline. And it's actually not as sexist and misogynistic as I thought when I first saw it. I was like, oh my God, that's a little bizarre. No, really, he had a compelling argument. Since he suggested that women account for 80% of household consumer spending, only when women feel comfortable spending Bitcoin for household purchases, will we start to see acceptance soar? And when that happens, we're going to start to see the price of Bitcoin roar. And he's still talking about $250,000. Yeah, I don't know. I don't have an estimate, an idea about this, guys. I really don't. He's violated a rule of forecasting here. Specifically, the rule of forecasting is if you name the amount, don't name the date. And if you name the date, don't name the amount. If he just said that someday Bitcoin would be $250,000, he'd be right. But he had to go out and say the amount and the date. He's got more money than me, so please, Tim, bring it on. I wouldn't complain about that at all. Final thing, and I wrote this up with my clients about 2 weeks ago. I pushed it out to Medium earlier this evening, and we're looking here at the seasonality of Bitcoin. Seasonality, of course, is highly suspect for many commodities. Academics quote the efficient markets hypothesis. They say seasonality doesn't exist. Well, if you take a look at the chart of gold, you'll see that seasonality definitely exists. We can see it here with Bitcoin as well. For instance, take a look at, and the way you read this chart is the histogram tells you how many months, the percentage of months that Bitcoin closed higher than it opened. So the number at the top tells you the percent of months that Bitcoin closed higher than it opened. The number at bottom tells you the average gain or loss for each month. In February, 88% of the time, 88% of Februaries from 2014 to 2022, Bitcoin rose, an average of 12.5%. Take a look at September. September, Bitcoin only rose 25% of available months from 2014 to 2022. It actually showed a loss. It punched a loss, printed a loss of 7.8% for the month of September. You know me, I don't care. Every Friday, as I shared with you guys, I buy Bitcoin. It's called dollar cost averaging. I've been doing it for years. You might want to consider taking up the habit as well. It's a way to spread your purchases over a relatively long horizon. You're not impacted by local price spikes or drops. You just buy at a nice, slow, steady average. You're going to get rich using this approach. You're going to get rich slowly. And that's the only way it works, guys. Forget all this get rich fast garbage. Just resign yourself to the fact that building wealth is going to take you 10 to maybe 20 years. The sooner you get the religion, the sooner you'll get the wealth. It really works that simply. Thanks so much for your time, guys. It's been a real pleasure. You have a wonderful weekend and a fantastic week coming up. We're all going to make some money. Take care.